Welcome to the Sage Planning Solutions Podcast. Join us as we help you navigate life's financial obstacles and find financial freedom. We will cover the major pitfalls that can derail your journey to financial independence. Get ready to learn, grow, and prepare for your best possible financial future.
Securities and advisory services offered through Cateray Grant & Company Incorporated, a registered investment advisor and member FINRA SIPC. Cateray Grant and Sage Planning Solutions are separate and unaffiliated entities. The information provided here is for general informational purposes only and should not be considered an individualized recommendation or personalized investment advice. Any opinions or forecasts contained herein reflect the subjective judgments and assumptions of the authors only and do not necessarily reflect the views of Cateray Grant & Company Incorporated. Investing is subject to risks including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. This information is not intended to be a substitute for specific individualized tax, legal, or investment planning advice. Neither Cateray Grant & Company Incorporated nor its registered representatives or employees provide tax or legal services. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice.
Julie, thank you for joining us. How are you?
I'm doing great. How about yourself?
Doing very good.
Hi, Julie.
So great to meet you.
Julie is an estate attorney, and we would like to jump in really just the basics of estate planning. I think one of the first things, from my conversations at least, that gets people confused is what is the difference between an estate plan, a trust, and a will? A lot of people think that you can make a will on the back of a paper bag or on the back of a napkin and they're protected from probate. So can you walk us through some scenarios and just explain the differences?
So if you have nothing or a will, it goes to probate court. Probate court is a civil law court. It takes about 2 to 3 years to go through, and it starts at 4% statutory fees, and that's your entire estate worth. So fair market value of your house, not the equity. Life insurance policy payouts, retirement, it's everything. So only a trust can avoid probate.
Tell us why we want to avoid probate.
Probate court takes 2 to 3 years. So I'm an estate planner. I set up the trust, and I administer the trust after passing. Everything's done in my office. If a beneficiary is also the trustee, usually that's done pretty quickly. If we have other beneficiaries, that's done within 4 to 6 months. It's quick. Probate takes 2 to 3 years in the civil law court.
Isn't it also very expensive?
It's very expensive. Statutory fees start at 4%, and that could be hundreds of thousands to millions of dollars based on the size of the estate.
Mm-hmm.
What's the one thing you see people get wrong over and over again? It seems like there's, I don't want to use the word awareness, but a lot of people, our clients especially, they're pinged or nudged towards doing estate planning. They may have done something 20, 25 years ago, and they haven't updated trusts. They have new in-laws that they're not super crazy about. They've had an astronomical appreciation of real estate and most likely investment assets. With that backdrop, what's the one mistake you see made over and over again?
Definitely. I mean, not updating their estate plan, right? You should check in with your lawyer every year. Usually I update an estate plan every 5 to 10 years, really based on people's family situation, their estate, the tax law changes. But I would say mistakes, right? Doing it yourself online, that's the worst. That's why I go to court, legal Zoom. I go to litigation because you name your child, your oldest child, as the trustee, and they don't know what they're doing. They self-deal, they take the money for themselves. That's a disaster.
If they do take the money from themselves, from what I understand, that's considered a gift. The minute they gift themselves money. So for example, if they had a joint account, it's on with the parent, the minute they take the money for themselves and they use it, that's considered a gift. Is that true?
Well, that'd be different if it was with the parent. But as soon as the parents have died, you take on that responsibility and that liability to the beneficiaries. It doesn't even matter if you're a beneficiary yourself. You have to put the others first. So that you could be removed and sued for if you take out money. It has to be the expenses of the trust. You can't distribute early. What you're talking about, Dominic, might be Medi-Cal planning gifts. Sometimes people remove money to spend down the estate to qualify for Medi-Cal.
Now, what if I have durable power of attorney, I have full authority, and I pass away? What happens at that point? Whose estate does it go to?
Well, your power of attorney dies with you. That's only a document during your lifetime.
Okay.
So you need a trust and established beneficiaries. So that power of attorney does not matter.
Julie, quick question. What's the difference between a living trust and a full estate plan?
So those are different documents. The trust itself, it encompasses all your assets. It names the grantors. Those are the individuals that set up the trust, the trustees, the managers during your life, and then the successor trustees who manages it after your death. It names the beneficiaries and the terms of that trust. That's what a trust encompasses. But an estate plan is multiple documents. So a pour-over will. A pour-over will works if you don't retitle your assets to the trust. So if you don't retitle your accounts to the trust, then I use that pour-over will. It's still a court petition. It's called a 850 Hegstead petition. I have to petition the court, show them the schedule, and ask the judge to move it in the trust. That's how a pour-over will works. It grabs all your assets. Now, if somebody works with a basic estate planner, they think they're fine because they haven't moved their assets to the trust. So I still end up in court. It takes time. It takes expenses. It's good to tie all your assets into the trust. That's so important.
One of the things that I think when our clients hear things like this, they get very lost very quickly in the minutia and the legal explanations. I guess plain spoken, how would you describe what are the experiences of most people? And I know that's kind of hard to say, but just sort of our clients are Mr. and Mrs. Main Street, typically the kind of the millionaire next door. And they might have $4, $5, $6 million worth of assets in their estate when they pass away. And I think what I'm looking to do is being able to tell them, here's why this is really important that you handle it this way. How could you do that without getting too into the, just the legal minutia?
How would you explain it to them, or how would I explain it to them?
How would you have us explain it to them?
I break everything down for them, graph it out for them. So for them, definitely would go through probate, and then other things they're not thinking about. For instance, Prop 19, that took effect in February of 2021, inheritance on your real estate. So the law used to be that you can give your primary residence unlimitedly to your children. And now that's changed. Your children have to live there. So a common mistake I see is people put all their children on as beneficiaries, and all of your assets are often considered the residue or the whole. So that home is treated equally. Well, maybe one child moves in and the rest don't. You're reassessed on those children that don't move in. So every tax law, I'm a tax expert, I would take them through based on the assets. I would go through the consequences with them that they might not be aware of.
That's interesting. That was Prop 19 that caused that, right?
Exactly.
Yep.
It was also, you could give up to $1 million of rental property to your children, but that's gone away now. So there's a lot I can do with that. People come to me. Had a gentleman last year, he came to me, he inherited property from his mom, already had a primary home with his wife. So I moved the real estate as the wife's separate property. So she still got her homestead exemption. And then the husband inherited the mom's property and got the Prop 19. They've been married for a long time. And in case they divorce, I did a post-nuptial agreement for them that everything was still considered community property. But it worked at the county.
Here's something I've always said. You can't do a real financial plan without having the estate plan, because the estate plan lists every asset, whereas a financial plan only lists what the client is willing to share with you. And in some cases, they forget, which is another reason why a lot of people need an estate plan.
Well, yeah, that's the biggest one, right? And then people don't know, your trustees, your beneficiaries don't know that account exists, especially life insurance, retirement. It's hard to go after it.
Another one was irrevocable living life insurance trust. A lot of people, they get them confused. And what are the limits? Are they still, was it $13.2 million per individual for a estate plan? And if you're under that, there's no estate tax. Can you walk us through that?
Sure. Estate tax limits, if you die this year, $13.5 million. That's per spouse or individual. It goes up to $13.75 next year. We thought that was going to expire because that law is set to expire. Likely that law will be extended. Though that's the law, people don't think about if they're not a citizen. So even if you have a green card, but you're not a citizen, you don't get that full exemption. It's only U.S. citizens that are going to get that exemption from their spouse.
Right.
So let me back this up. If you're married, everything is considered community property, 50-50. So you're inheriting that 50% from your spouse. If that spouse, the one living, is not a U.S. citizen, they're going to be taxed on that money. So with that, I set up a qualified domestic trust. It qualifies them as a U.S. citizen. They don't pay that tax. So a lot of people don't take that into account because they just don't know.
You're not granting citizenship to the non-U.S. citizen. The trust is domiciled in the United States. Therefore, is that accurate?
Yeah, it's a great question. So usually trusts are a pass-through, considered grantor trusts. So we use our tax ID to recognize it, our own social security number. But if we have an irrevocable trust, it gets its own tax ID. So it separates it as its own entity. So I create the paragraphs in that trust, and then it qualifies the individual as a U.S. citizen. If we partner them with a U.S. citizen, then they're co-trustees.
Interesting. Okay.
A lot of loopholes is what I'm understanding.
But within the law, within the probate code, we follow the probate code in California. for our estate planning law, and then the IRS code.
You worked with many advisors before. What are some of the misconceptions that you've come across working with advisors that have a misunderstanding of, primarily because these are the questions that we get from clients?
Right.
What would a few of those be?
Well, I talked to a financial planner the other day, and he told me he only plans for clients for estate tax above 40 million. And of course, that's completely wrong. If you're above that certain threshold, you're going to be taxed at a 40% rate.
Walk us through, for example, if you have money in a trust, the tax of a trust, I don't think people realize the implication of how high those are.
Well, it depends where you're at, right? So if it's a grantor trust, it's a pass-through. It's your own social security, so it's your own tax bracket. But then if you're the beneficiary of the trust, it's treated differently. But we try to push out the income to the beneficiaries, so it's taxed at their individual tax bracket. And then the trust takes a deduction, because the trust files a tax return and then the individual files a tax return. Now, if that beneficiary is a high earner, right, and they're in the highest tax bracket anyways, it wouldn't matter. But yeah, Dominic, you're right. The trust is the highest tax bracket under the law. So it all, there's considerations, and that's why we team up. We work with financial planners, such as yourself, and we work with CPAs, make sure it's done correctly.
Do work with asset protection trusts obviously for Medicaid, and let's say second, third marriages. In lieu of writing a prenup every time, is an asset protection trust or an irrevocable trust the right solution there?
Well, those are great questions. Common misconceptions you just brought up. So a prenup only affects you if you get divorced. An estate plan affects death. Medicaid, that's a federal law rule. In California, we do Medi-Cal. So of course, there's certain qualifying factors for that. You don't need an irrevocable trust. That changed. A revocable trust will do the trick. I'm happy to take clients through that. Yeah, there's a big difference on that one. Mm-hmm. And then the main trust between spouses, we could certainly lock it in when one individual dies if we're concerned about remarriage.
Lock it in meaning a portion of the estate is irrevocable.
Right. Usually the decedent's portion goes into an irrevocable trust. It gets its own tax ID. We could put parameters on that, or if they decide to get remarried, they have to sign a prenuptial agreement protecting their rights and the rights of their children. Otherwise, that surviving spouse doesn't get access to the principal anymore.
But the surviving spouse can be the trustee on an irrevocable trust or the asset protection trust.
They can be, but that's not the best. So if you're concerned about your children eventually inheriting and somebody coming in, a girlfriend, a boyfriend, spending down the estate, changing the trust, it's better there's a different trustee or a co-trustee. And for asset protection, if you're your own trustee, the court will just go right in there and take it. There's no protection. I do irrevocable trusts from the onset. I do those for asset protection. My clients are never their own trustee.
So you would say that your office or a trusted child would be a trustee?
That's what clients always want, but in trust litigation. So besides not giving to your children equally, that's the number one reason people fight. The second reason people fight is you name your child as the trustee. So I always encourage my clients to have an independent trustee.
Can you share with us the difference between using you versus a professional fiduciary trustee?
Oh, well, those are different roles. So I'm the lawyer that drafts the trust. I'm the lawyer that represents the trustee after the parents die and they need to do distribution. A trust company, they're their own entity, and they would be the trustee investing, making distributions. That's a separate role. They often hire me to represent them so they don't take on liability. They're doing things correctly, but we're two different roles. And I would never be a trustee for clients. That's a conflict of interest.
You said they invest. So the fiduciaries don't invest. The fiduciaries work with advisors who invest, correct?
So it's the trustee's job. And usually the trustee will hire advisors, yes, financial planners, but it's their job to select those individuals.
Will an asset protection trust protect the assets from divorce? In the case of, let's say people get married, there's substantial assets, maybe on one side, maybe on both sides. Will an asset protection trust or an irrevocable trust satisfy or protect the assets from divorce?
Well, that's a complicated question, but a lot of times people will come to me to set up a trust before marriage so that we could separate the assets. It depends. The family law rules are complex. There's commingling. So you have a separate property account, but then you add your spouse to title. Or the biggest one is you use household expenditures from your separate property account. That becomes community. Another big one I see, you go in, you have a separate property home, you go in for a refinance, and then you're adding your spouse to title. That's considered a transmutation. We also have rules within the family law code. If you haven't paid off your house, and usually your salary is considered 50-50 community property, then that spouse is entitled to a percentage of that home. So not necessarily will the trust protect it. They have to be properly advised how to hold their assets and not to commingle or transmute. A transmutation means we're changing the character. We change it from separate property to community property. And that could easily be done with a refinance without even knowing it.
Is it possible to unwind commingled assets? So for example, if a client inherited, we always recommend, the first thing we do is say, hey, look, create a separate property trust, meet with an attorney, definitely don't commingle these inherited assets. But you know how married people go, and don't worry, it's going to be fine. And I'm working on a case now where a client did that, commingled, and now they're trying to unwind. And you know how complicated it gets because the money went in, they bought a house for their daughter, they sold that house, they bought another house. So the assets get really murky.
Yes.
But will the courts allow some untangling of commingled assets?
Yes. So there's tracing under the law. So you go back and trace it, or refinance. You tell the court you did that as a matter of convenience, but it's all argued over, right? It's not black and white. So it's better to get the advice and counsel from the onset. And then as you carry on through your financial planning or your estate planning, you continue to seek that counsel to make sure you're doing it correctly.
Yeah, it's always better to seek advice, but you know how people are. We always, the first thing we do when clients, inherit money is say, listen, don't commingle. And then they do, and sometimes it gets messy.
That's true.
I've even had somebody say, you know what, this is all too complicated. They could deal with all my stuff after I pass away. I don't care. It's not my problem.
Those are people that don't care about people they're leaving behind. If you care about your children, you're setting something up.
I can share my own experience. In fact, this may be helpful for people. My dad didn't have a lot of money. He had about $200,000 in equity when he passed. And I kept telling him, look, you need a trust. And he's like, I don't need a trust. I have you as my executor on my will. And when he passed, and of course I stomped my feet and pounded the table, but he just wouldn't do it. When he passed away, we went through probate, and probate cost $30,000 on $200,000, a total equity after. And I spent countless hours dealing with paperwork in the courts and attorneys. And by the way, $30,000 was probate. The attorney was probably another $5,000. So imagine $35,000 of $200,000. Right. Yeah. So probate's messy and expensive, and it was a lot of work. The other thing that happened was one of his estranged daughters showed up and dragged me through the mud because she was trying to extort money. She wanted me to pay her off to go away because she went on all the social media and said all these horrible things, even though just to try to threaten me into giving her some of the $200,000 that was left, which wouldn't have happened if there was a living trust.
Right.
It's so critical. I mean, and that was no money. I'm not saying $200,000 not a lot of money, but I mean for the amount of work that I did and the amount of headache we had of lawyers and restraining orders and all this other stuff, which would not have happened if he had a living trust.
Exactly.
Restraining orders. I've never heard of people having restraining orders when you're dealing with an estate plan.
We had to get because we went through probate, and she went on Facebook and LinkedIn and YouTube and accused us of all kinds of crazy things to try to get me to just pay her to shut up and go away. But what we had to do instead was get a restraining order so she was not allowed to say all of these damaging things and damage our business reputation. So it gets messy and none of that would have happened if we had a living trust, because she wouldn't have had a claim. Living trust and estate plans. And the other thing about an estate plan versus a living trust, an estate plan, I would say, if you come in and say, look, I need all of it, right? You need advanced health care directives. You need somebody who's going to decide when to pull the plug if something, if they're brain dead, et cetera, something extreme. So an estate plan, I would say, includes a living trust, healthcare directives, as you said earlier, a pour over will, and then the power of attorney for healthcare, power of attorney for finance, and then a durable power of attorney. So actually, why don't you share with us the differences between the powers of attorney for healthcare, finance, and durable?
Sure. A durable power of attorney is for finances. Healthcare directive is for medical decisions. I'd say the biggest mistake that I see for powers of attorney, because I'm a very functional lawyer, I don't just set up the estate plan, but if a client is elderly, they have Alzheimer's, their power of attorney has to work. So often lawyers will do springing power of attorneys, which you have to get 2 physicians' letters to use the document. And that's really difficult to obtain. So either I never get them or it takes 6 months for doctors to produce these letters. And these individuals, they need their money. So my powers of attorney, as long as you trust the agents you're naming, they're always immediate. And these work great. So if somebody's out of the country, right, like Prop 19, so many people need to move their real estate at that time, you can use the power of attorney to sign over your real estate. So those are really helpful. Advanced healthcare directives, that's the directive in the hospital when you can't make your own medical decisions. Of course, those really come in handy if your agents are not your immediate family members, right? You have to name those other individuals and then calling out your wishes ahead. So you're provided for and you're taken care of.
Mm-hmm.
Brad, what you were mentioning, it's even worse in California. It's half to the lawyer, the statutory fees.
That's crazy. Yeah, that was Oregon.
Yeah.
You're saying 50% goes to the, holy smokes.
50% goes to the trustee, the executor, and 50% goes to the lawyer. We get fees for extraordinary as well. So if we work to sell a house with a real estate agent, we'll get fees.
Get the living trust.
Something that Pat always asks is, what are the 1 or 2 things that would keep people up at night when it comes to developing a trust?
Oh, well, children, right? Especially if you have minors. That's a big one. What I see the most common mistake with my clients that have minors, they always put their children as beneficiaries. But until your child reaches 18, we still have to go to probate court to get that life insurance policy payout. So we set up a trust, right? And then you can grab it under the trust. That's a big one. So if you have children, that keeps you up at night until you have a trust.
It sounds like what you just said is if the children are minors, make the trust the beneficiary, not the children.
Exactly.
Okay. But if they're above 18, then...
If they're above 18, it depends, right? So one thing, if a child predeceases, God forbid, there's no backup. So you need the backup in the trust. And most of my clients, their high estate worth, we do asset protection for their children. So the asset protection kicks in when the parents pass. The trust is irrevocable. It's similar to an LLC. Somebody else is managing their money for them. They're protected from lawsuits, bankruptcy, divorce, half of it coming out on a divorce. And usually that grows the estate over time and it saves more in taxes. So still in that case, the trust is the beneficiary.
Got it. That's great. One thing that, so walk us through in a very brief way what your process is, because I found that, well, we all find that our clients procrastinate because it's going to be a lot of work. It's going to be complicated. Sometimes you've got blended families, right? We've got his kids and her kids, and they've got to sit together in a chair in front of you and say, I want my son to get X, and your daughter's a mess. And so walk us through in a very brief. It happens all the time, right? I mean, I should, my wife and I are rewriting my trust because our assets have expanded so substantially, and it's hard to sit there and say, well, my son, because my son pre-existed my wife, and so it's challenging. It's hard to sit there, and it's a very hard conversation sometimes. If there's some families where everything's great, all the kids are ours, and all the kids are going to get the same amount of money, but sometimes we've got a squeaky wheel. He's only going to get 10%. And by the way, if he doesn't shape up, he's getting none of it, right? So I think that people avoid this because they don't want to deal with it. So how do you get people out of their seats and into the game?
How do you address the squeaky wheel?
I lecture that child. Had a client the other day I was lecturing, but they're a current client, so I won't speak of it. So I bring them into the room, right? I'm happy to serve as the mediator. I have those hard conversations that they could have in front of me that they don't want to have together. And my approach is always equal because that's the probate code and that's the way people don't fight. If your children fight on your estate after you're gone, it spends down the estate. If they don't want that, then we come up with options. We come up with other approaches, right? So we just walk it through.
Why do people have the misconception, I'm never going to have to pay any estate tax? I'm going to inherit a primary residence that my parents had, some investment accounts, a couple checking and savings accounts, some CDs. Why is it that people say, I'm never going to have to worry about paying estate tax because it's not above the exclusion?
Let me piggyback on that before you answer. The layman's term is inheritance tax, the tax they pay on their inheritance.
So I think people are confused about the taxes. Estate tax is the overall estate, everything you own. Capital gains tax is something very different. So it's a federal law rule. Any appreciated assets, real estate or stock is stepped up if a parent dies, and then it eliminates capital gains tax. That's a big problem that I see with AB trusts. That's old estate planning. So if somebody hasn't had their trust looked at in years, it's usually in there, it's a problem. If one individual dies, it will set the basis. Instead of the basis you purchased your home, it's going to set the basis to that first spouse to die. If that's in a B trust, then and the surviving spouse lives for 20 more years, there's 20 years of capital gains tax.
I think that AB trust sort of became less relevant in 2012 when the inheritance taxes went, when the amount that you can inherit tax free went up. So what do you do in a case where clients have an old AB trust? Do you wipe it out and start from scratch, or do you amend their existing estate plan?
I never do amendments. Amendments are terrible because can you imagine your father just died, you're mourning the loss, you get a huge packet in the mail from a lawyer, you can't even understand the trust, and then there's an amendment on top of it. I never amend a trust. I always restate. So in a restatement, we keep the original name of trust and date. That's important for the funding and title work, but it's a new document, and then we follow that new document. So if the couple's both still living, great, I can update it. I do a new trust for them to make sure they get the double step up in basis. What that means is, for instance, your home, the basis would be the amount you purchased it at. And if you were to sell it, there'd be capital gains tax. Well, 100% could be stepped up to the first spouse to die, and then 100% stepped up again for your children. So I get that all fixed within my trust. It's called a Clayton or Q-tip election under the IRS code, if you've heard of it.
Yeah.
But the problem is if somebody's died, then that trust is mandatory, that B trust. And so I have to take it to court to revoke it. Yeah.
Have you seen the court reject a revocation of a B trust?
Santa Clara County, where we're at, they don't reject as long as all the beneficiaries consent. All the beneficiaries consent, we're good to go. And we don't even have a hearing for that, which is really great. But if the beneficiaries don't consent, we could battle it out. And we have to show the benefits of revoking it.
Crypto is considered an asset, not a security. Does it step up on the death of a spouse?
I'm not an expert on crypto.
Is that still a gray area?
Yeah. I have an accountant that I seek his help on that, but I wouldn't speak to that.
Copy that.
No, the AB trust above ground, below ground. Can you walk us through the very basics of what that is for the listeners?
Sure. AB trust, A means above ground, so the surviving spouse. And then the B trust is below ground for the decedent, the spouse who died. And so usually 50% of their assets get moved to that B trust.
And what are the implications for that?
So the problem is it sets the basis so we don't get a double step up when the final spouse dies for the children. It's a restrictive trust. It gets its own tax ID. So we have to file annual tax returns. We have to do accountings. And usually people don't do that, right? Unless they're working with a lawyer. None of that's done. You also usually can't amend the trust. And maybe the surviving spouse wants to amend the trust.
Is there a bypass trust in that?
So usually the survivor can amend their surviving trust, but not the bypass trust, the irrevocable trust. For my trust, I put in a trust protector. A trust protector can amend the trust without going to court, only in the best interest of the beneficiaries. Usually that's me, but it doesn't have to be me. My clients can decide another trust protector, and it allows for checks and balances between the trustees and the beneficiaries. It's really helpful.
Now I'm going to throw a curveball to you here, which I know you know. There's all these digital platforms that are coming out trying to piggyback off of the type of work you do. What is your opinion about them? There's LegalZoom, as you mentioned earlier, to name one of them. What is it that they can do? Because a lot of it's template based for the basics. What is it that you can do that they cannot, other than going to probate?
Yeah. I mean, everybody just says, oh, it's a template. You just have a template, Julie. That's not how it works, right?
Right, of course.
The ins and outs of the law, and then the consequences, and then the years of experience, what I've seen and how we can avoid that. And even other great estate planners, they'll go into a software. And if they don't know the answer to that question, or if they don't know that tax law, they can answer it correctly. So I can't imagine a client going in there and doing it.
Yeah, I don't, DIY is great if you've got 0 to no assets, but I mean, it's, this is not something you want to try to do. Don't try this at home.
No, definitely not.
One question I have is that when we have people that have pretty civil families, not high net worth, but substantial enough assets where you do want to start this process. And if they said, hey, I went into one of the online, and I set up the basics, can I then send somebody who's already set up the basics to you, and can you help them forward it from there?
Oh, definitely. Yes. And that comes up a lot. Or they'll use basic estate planners. So they already have a trust in place, that name and date.
Yeah.
But I'll take it, every asset through with them. I'll explain the tax laws and asset protection and consequences and how it can benefit them. And then we just update the trust, but we still keep that original name and date.
Mm-hmm. Because there's a lot of times where people want to do something, and then once they start interviewing estate planners, they absolutely get bowled over by all of the legal talk, all of the things that are so above their pay grade. And so you put yourself into the position of, I have no idea what they're talking about. I've heard lots of horror stories. Who do I trust the most? And that could put somebody in an absolute lockdown for years before they eventually do something. So we would love to be able to tell somebody, go in, open it up, get it started. And then how about this? Why don't we have more and more discussions about what you're going to want this to look like over time? We've seen AB trusts that were done in the 80s that are so ill-fitting now. It's just like, it's like ancient history. And like, no, this is what we were told to do at the time. And this is what they were really excited about. And it's like, well, I hate to tell you this, but you're going to go pay someone 10 grand to retrofit this. Or we're going to, you're in for a lot of homework. We could kind of tell them straight like that. And a lot of times it just scares people away from having to do it in the first place. So if somebody wanted to not have to go through, if they wanted the softer, gentler way, instead of have to go through in interviewing estate planning attorneys, how would you just say, I want you to get started this way, and when you're ready, come to me?
I guess I would have them read. I mean, they could read on my website, right? Or I have brochures, but I prefer to have that conversation with my client. Right. And for each client, it's based on their specific estate, their questions, their complexity. So I'll speak to them. I won't, I know we've gone through a lot of taxes here, but that's not a typical conversation. It's usually, who's your family? How's your family doing? Who are your beneficiaries? And, we just go through the basics. So we'll break it down and we'll have multiple conversations. I'd like them to understand everything. People do want to read on their own, and I encourage them not to because I'd rather explain it to them. It's just too confusing online.
Do you litigate? Do you personally litigate?
I do.
One of the things we found with litigators is that they'll get wrapped up in a case and they hit bandwidth issues. What do you do about your bandwidth if you're litigating and you're stuck in court for significant periods of time?
It's hard. I mean, you staff up, so you definitely have to have a team for that. Most cases settle. Yeah, but you just staff up, make sure you have the resources. It is very expensive.
Yeah, and the other thing is you want somebody who has litigated and who litigates, because you can reverse engineer into their case based on the things that you've seen, that you've actually litigated in court.
That's true. So it doesn't matter how much you study or look things up. Every county has different roles, and it's all experience. So if you haven't experienced it, you just don't know. So if I'm on a new case, I'm calling another lawyer. Hey, have you seen this before? And I've been in the industry for a long time, so people come to me all the time as well. Hey, what have you seen, Julie? So it's all about experience. But that experience helps make a better trust for clients because we've seen those consequences. We can anticipate them and we can avoid them by catching it on the front end. Yep. A lot of estate planners are basic, right? Whatever the client says, they just put it in there. But that's kind of like putting together a baseball game and never seeing the baseball game played out. Did your estate plan work or not? So you definitely need qualified advice from an expert.
So it's like, I'm sure you've ran across someone just like we have that has a PhD in YouTube and in litigation. YouTube said this, but as you had just specifically said, each county has their own set of laws.
I get that all the time. Yeah. So then I just have to tell them the actual law. And, those do-it-yourselfers, I send them the law. Well, here's the quote. Here you go.
Yeah. Good luck with that.
But I was going to mention, because Pat, earlier you were talking about somebody with a lesser estate. Our probate threshold in California is anything above 180,000. So it's not that much. People think, oh, I don't have an estate. I don't have millions. 180,000 isn't that much. So you need a trust if you're worth more than 180,000.
Sorry, our specialty is under $100,000. I'm sorry, I can't help you.
Opposite of the advisor that only does $40 million plus.
Yeah, totally opposite.
That's hilarious.
Yeah.
You have put very clearly in my mind that people need to have conversations with you.
Mm-hmm. Oh, I appreciate that.
This is a many cups of coffee endeavor. This is not a hey, let's jump online and figure it out and watch some YouTube videos. The cost of ignorance is too high.
Yeah, that's for sure. I mean, I could sit here all day and tell you 100 stories of consequences.
Yeah.
And that's usually, it's just hard to get people to do an estate plan unless they know of those consequences. So I had a lady the other day I was talking to, and her coworker's husband died. And then she was in probate, the wife, and it was awful. It was expensive. It was time consuming. And so then it encouraged her to do a trust. And too often than not, that's what I hear. Somebody has experienced consequence of not doing an estate plan, and then they realize they need one.
How do you assure clients will fund the trust? Because we see that a lot. Even our clients who are sophisticated. Hey, are the bank accounts in the trust? No, actually, I own the house with my mom. Mm-hmm. So if something happens to her, everything's fine. When it's not, because that puts 50% of the joint owner's liability on mom, which shouldn't be there. And so how do you assure that clients sort of understand this and they and give them actionable tasks to go get it done?
Well, that's a whole discussion with my clients. The funding, the real estate deeds, I do myself, and all the county assessor forms, I do myself. Clients never touch those because that's always a disaster. Had an individual the other day, she did her trust online and then she did the deed work and they reassessed it and then she found me.
Oh.
Yeah.
Oh.
It's a big problem.
Just to explain that, when you change ownership, the county will reassess if it's a new owner.
The county assessor, 50% or more change of ownership, unless there's an exemption. A trust is an exemption. They reassess the property to current fair market value. So you definitely want your lawyer. Yeah.
Right. But you're not, in most cases, you're not changing ownership because you are still the trustee of the trust. It just looks to them like a transaction. So you've got to be proactive on the front end and make sure they know this is not an actual change of ownership.
Exactly. So all our exemption codes are on the deeds and the county assessor forms, ensuring that our clients aren't reassessed. It's all exempt because it goes into a trust.
You're going to get a nice tax bill on that assessment.
It's true. So a few things there on my worksheets. I always ask my clients who their financial planners are so I could connect with them and make sure everything's retitled. I give them homework. I check in with them. That's all very important for the titling.
We like that. I mean, having a protocol and a process, we feel is very important. Meeting agendas, and just because you want to make sure you fully understand, and they look at you from our perspective as they would your doctor and your attorney. Same concept, because we do partner with accountants and estate planners because we do believe it's important to understand the full financial picture of each client and give them the information that we're talking about right now that is not easily accessible online because you can get lost in the weeds just trying to Google whatever.
Yeah, it's very important. I had a client the other day, they came in, they didn't want to give me any information. So step by step, they slowly started telling me about their real estate. Turns out they have 5 pieces of real estate. That's so important for me. I have to check the title. I have to know who's on title. And this couple had their sons on title. Brad, you were mentioning this earlier. It's a problem. If you're on title with a child, you don't get that step up. And so I always encourage people to transfer it to the parent. Then they inherit through an estate plan, and then they'll get the step up to eliminate capital gains tax. So we always go through title of the real estate. That's really important.
All right. Well, we appreciate you coming on, Julie. This was extremely informative, very helpful. Any other questions, gentlemen?
No, that's everything. Great job explaining this in plain English.
Thank you.
The complexity of this is far beyond what it was 20 and 25 years ago when people first started looking into estate plans in their late 50s, early 60s. And trying to do anything other than consult someone like you would just be, they have no idea the waters that they're wading into. Thanks so much for taking the time to explain the stuff. I know it can get daunting, but I think it's what people need to hear. Thank you.
Of course. Yeah, I appreciate that. Thank you. And no, it's not daunting. I enjoy it. This is what I thrive on.
It's daunting for us.
Yeah.
Well, we're not smart enough to get through law school, so.
Well, thank you, Julie. Have a good day.
Yeah, have a good day. Bye, guys.
Thank you.
Bye-bye.
Thanks, Julie.
Thanks for listening to the Sage Planning Solutions podcast. Be sure to subscribe so you don't miss the next episode. If you want more information, visit our website at sageplanningsolutions.com.